A massive $1 billion tech infrastructure bet in East Africa is facing unexpected delays as Microsoft clashes with the Kenyan government over payment disputes. This is putting a temporary freeze on what was supposed to be a cornerstone for the region's digital future. Meanwhile, in South Africa, TymeBank is redefining employee incentive by turning all 2,000 of its staff members into shareholders, proving that equity ownership isn't just for the executive suite. And the brutal reality check of startup survival hits home as cross-border payment fintech Chimoni shuts down. While the founder maintains that the product worked beautifully and blames a lack of distribution, public customer reviews are painting a much more complicated picture. These and more stories on tech and innovation in Africa. Hello, everybody, and welcome to the Tech Tides Africa podcast. My name is Karen, coming to you from Kenya, and I'm joined from Nigeria by the wonderful Kelvin. How are you, Kelvin?
I'm doing good. I'm doing great. It's a cold morning, but yeah, I'm doing good. How are you doing?
I'm doing amazing. As I told you, we are facing public transport strikes in Kenya, so everyone is working from home today. It's a quiet day. We don't have matatus, which is our public transport vehicles. A lot of our boda Okada guys have stayed home today. We had quite a massive hike in prices, in fuel prices last week, so everyone's staying home today. And luckily, we have some good stories to keep us company. We have some major things that have happened in Africa, and starting us off is the Microsoft's 1 billion East Africa data center that has hit a wall. There's this anticipated tech infrastructure play between Microsoft and an Abu Dhabi based partner, G42, that was announced in 2024. We had our president visit Washington, D.C. and actually inaugurate the project. It's supposed to be geothermal powered. It's a data center of about 100 megawatt. It needs a potential amount of 100 megawatts, scaling to 1 gigawatt. The facility was designed to give Africa its own Azure cloud region. However, they need the government to commit a certain amount of payments and usage of the data center before they can come in. And that's where we're seeing they've hit a bit of a roadblock because the Kenyan government is not able to give those guarantees.
I mean, it's a lot of guarantees Microsoft is requesting for, and the Kenyan government is simply thinking about how much power is required to run this data center when they have, well, the citizens to supply power to. And they are basically putting it in sense of if they have to give these guarantees, then it will shut down half of the entire country, which kind of sounds like an exaggeration, but we know these data centers require a lot of power to run. And as much as the innovation is very important, the opportunities it brings are also quite important. But then there has to be a way to make sure that you are not shortchanging the citizens just for the sake of innovation. Yeah, I think this is where the tension currently is. It's something that they'll probably figure out a way to facilitate this project, but at the moment it's in a bit of a stall. Yeah, that's where we currently are. So quite an impressive project, a $1 billion data center. Definitely something that will be state of the art. You can have these cloud services closer to the region, and this means your web services can be deployed closer to home, which means they'll be faster and take less time to respond to requests and things like that. So there are advantages of it, but I mean the economics have to make sense.
Yeah, absolutely. I think as a country, we've been having the conversation of power capacity for a while now. There were discussions around it last year. And last week, we saw something come out, which I'm not sure if it's connected to this, where EPRA, which is our energy authority, said that it wants to open up the energy industry and allow independent power producers to distribute power to everyone. So they're opening up and removing that monopoly by Kenya Power Lighting Company. So currently, if I'm an independent power producer, I have to sell my energy to KPLC, and then KPLC does the distribution to people. what the government was trying to do was to allow me as the or whoever is the independent power producer to produce the energy and then send it directly or distribute it directly to customers so that we can open up that industry and create more energy for the country. Now, I haven't seen any gazette notice yet or official communication from the authority. So this is based on news on the media, but I'm yet to see official documentation. So I'm waiting to see on that. But I do think that that could be part of the solution. We have quite a number of power purchasing organizations that have been waiting for licenses and power purchase agreements to be able to produce power. So this might enable us to get there. Then we can free up the geothermal power for the data center, possibly, while we use other forms of energy, renewable energy especially, to reach the common mwananchi and to reach other big companies in the country. So perhaps that will be a solution, but nothing official yet. We're waiting to see.
It seems like a tough time to get licenses in Kenya at the moment because you just talked about the licenses that these power holding companies are trying to get. We also know that it's hard for startups to get licenses at the moment in Kenya. That's why Money Points, we saw it a couple of weeks ago, went through the route of acquiring a microfinance bank, I think, in Kenya. So that's something that I'm thinking about and gone on for quite a while. I wonder if it has to do with just refinements in regulation that the government is trying to figure out, and that's why there's this lull in getting licenses, or if this is being caused by something else. But it's just something that I've noticed in Kenya for a while, that licenses are quite hard to get. But generally, we'll see how this all pans out with the power companies and the government and Microsoft. I believe it's something we'll definitely hear about sometime later in the year.
Yes, I don't want to comment because I like my life. I don't want to end up in prison. Let us just move on.
All right. Shifting gears, the Financial Times, in partnership with Statista, ranked 130 high growth businesses in Africa. And this is something they do every year. And to qualify to be on this list, companies need to demonstrate a minimal compound annual growth in revenue of 9.27% between 2021 and 2024. So for this 2026 list, they are taking into account your compound annual growth between 2021 and 2024, and your revenue has to start at $100,000 and hit a minimum of $1.5 million by 2024. So this is like the base criteria for being on this list. And last year around this time as well, on episode 15, I believe we talked about the list for 2025. At that time, we had 15 startups on the list. This year, we have 30 startups. So that's a double increase for startups on the list, because this is a list of businesses in general, not just startups. So there are now 30 startups on the list. And I think one of the significant things is that an Egyptian company is the number one company on the list, Tinder. Not Tinder, the dating app, but Tinder as in THNDR. So yeah, Karen, what do you think about the list this year?
Very interesting to see the growth. I'm happy at least Kenya is making some progress this year. Last year, I made a lot of noise because we seem to be shrinking. Not bad this year. I would like to focus on the types of startups that we're seeing winning, or the sectors that we've seen win on this list. As usual, fintech has to be there. I think as a continent, fintech is just our thing.
Undefeated. Undefeated.
It has to be. And if you see fintech, you best believe Nigeria has to be in the conversation. They're the kings of fintech, the kings and queens of fintech. So we give them that. I think it's about 40% of the list is in the fintech IT payment sector. Then we saw B2B commerce. I think at the beginning of the year, Kelvin, we talked about seeing a move towards B2B commerce.
Yeah.
We talked about a few companies moving from B2C to B2B to try and cushion themselves as the economy gets a little bit shaky, have clients that are more stable. We've seen quite a move, and now we are seeing them show up on the list, B2B commerce. Then we have logistics, which is insane. Very happy to see it here. We talked about it last week or a couple of weeks ago in transport and logistics coming up. And then finally, clean energy. We've talked about clean energy and how it's coming up, and we're seeing more and more investments coming in. We're seeing more and more startups coming in. So those are some of the organizations that I have seen that are kind of making noise on this list and winning on this list. So definitely spaces to think about. As usual, we're seeing Egypt rise very fast. Its market worth, it's the kinds of deals it's making. It's definitely a market to be watching. If someone has a startup that they're thinking of expanding, Egypt is definitely currently a market to watch. I don't know what it is that they're doing. I would probably want to look at the regulations, which you spoke about a while back, that they have quite good policies happening at the moment for their tech and for businesses in the country. So yeah, that's where my mind goes. I think we definitely have some spaces to watch. I would like to bet that we will see more B2B happening across the board, and we will definitely see more clean tech coming up because there's a lot of funding showing up for that and a lot of innovation and gaps that can be filled in that space.
Yeah, Egypt is definitely one to watch. Yeah, we'll be putting out that report soon. I believe they have some interesting policies that they are developing there that is attracting a lot of investment, which in turn is bringing all this growth. But yeah, we'll put out that report soon. South Africa is the other one that I think I found interesting because the overall out of 130 companies on the list there, 52 of them are South African. So that's definitely very impressive. That's about a third of the companies on the list from South Africa. And Kenya actually did one over Nigeria this time. Kenya had 17 companies and Nigeria had 16 companies on the list. So you guys lead us by one.
I'll take it.
Which
I'll take it.
and I found that quite interesting. Would see Nigeria. We need to kind of sit up, you know. But other than that, I think it's cool to talk about growth because these are some massive numbers. When you look at some of the individual performers, M-KOPA in Kenya's growth moved from $142 million to $417 million in 2024. Massive numbers there. South Africa's TymeBank moved from $15 million to $32 million. OmniRetail moved to $54 million. And Sabi, a Nigerian B2B commerce company, moved from $1.5 million to $46 million. So a lot of growth there. And funny enough, OmniRetail was like number one company for, I believe, 2 years in a row last year and the year before, something like that. But for this year, they actually dropped all the way down to 28 on the list, which quite a drop. But I know that OmniRetail is doing quite well from some other sources. But yeah,
Yeah.
there's growth happening. That's, I guess, the summary of everything. There's a lot of growth. There are a lot of companies doing well, and it's great for the continent.
Absolutely. And I would like to give a shout out to other countries that are perhaps not in the big four. Ghana, they had Regulus, a fintech platform, show up on the list. Uganda had, I think, two companies, Numida and Agro Supply. I think Numida is a digital lender, so it's fintech. Agro Supply is in the agricultural mobile savings platform for agri supply companies, so still in the fintech space. Cote d'Ivoire had one company coming in. It has a very hard name, French, La Paire. Does eyeglasses for users, which is really cool. And it uses tech to optimize customer acquisition, inventory, and supply chain. And then Mauritius had one company as well, Bridge. It's an AI powered global talent marketplace. And Tunisia had one MS solution, which is also in the fintech space. So big up to those countries. Really cool solutions. I'm definitely going to be looking at this eyeglasses one from Cote d'Ivoire because it's so different from everything else that we're used to, but definitely good news for African techpreneurs. All right, moving forward to the country that is currently in everyone's lips in the startup sector. I think we've talked about it a lot. Egypt, we see you, hats out to you, and they have done something that is quite rare. There's a cash exit in an Egyptian startup, Bosta, which is in the logistics space. I mean, talk about being a unicorn. This country is doing weird things. We're talking about logistic companies having hard times, and they're having a logistic company do a cash exit, which is quite rare. Most deals end in all stock swaps or paper valuations that evaporate on the second market. But Bosta, which was founded in 2017, has just delivered a cash exit built on venture capital and UAE based Citadel Holdings. They sold their joint stakes with a disclosed 75% internal rate of return booked as actual cash. That's just, yeah, I don't think I have read any deals that have had cash exits. I don't know whether you've had that experience from your end, Kelvin.
Maybe on like smaller scales, they have been, but we haven't really seen a big one in a while. Earlier in the year, we talked about Flutterwave's acquisition of Mono. It was a stock deal, and I believe there was another big one that we talked about from one of the big fintech companies. I can't remember which one, but it was also a stock deal. So we haven't really had like cash liquidity deal for a while now, and it has been raising some questions because we are talking about the maturity of the market, but the market is not providing the liquidity for investors to exit, which means that money is stuck in one place, right? They can't take some returns and put in other startups, and that's kind of the nature of the way investors work. So it's good that we have one at the moment that is providing this liquidity. But the question is it going to be a one off, or is it going to be a trend that we start to see for the rest of the year? The indicators at the moment is show that this is kind of a one off because the primary cause of this exit is an unnamed buyer that is currently trying to build a position ahead of Bosta's planned $170 million IPO that they are planning for later on the Egyptian exchange later this year. And it's an anonymous buyer that's currently making this move. They are looking at the revenues for this company. They certainly believe that there's a lot of value to be gotten from this company. And so they are putting their money there. So there are some unique circumstances that's happening over there, and I believe those are part of the drivers. Maybe it does happen more in Egypt because they are also creating a lot of regulations and policies that are favorable for investment. So maybe we see more cash deals that happen there, but doesn't at the moment look like it will become a trend that we'll start to see for the rest of the year.
Really good insights. Thank you for that, Kelvin. Because I do think, yes, it seems like a unicorn, especially given the really difficult macro conditions that are there across the board, not just in Africa, across the globe. We're having very severe economic conditions, which begs the question how cash exits should be even more rare. So the conditions behind this purchase definitely make more sense based on the insights that you've given.
And moving on to our next story, TymeBank has pulled off something quite interesting. They have completely changed the structure of compensation and rolled out a massive employee share ownership program for their employees, touching about 2,000 employees across South Africa, the Philippines, and Vietnam. Normally, shares are reserved for like executives at a company or some founding engineers and people like that, but they have decided to give pretty much all their employees some shares as compensation. And it's not something you see at all. So I'm quite fascinated by this particular story. And their bet is that they are looking at retention because in 2026, finding good talent is quite hard. I think 2 weeks ago on the Nigerian social media space, the conversation was revolving around a statement the Money Point CEO made about not having many mid level management and senior executive talents in Nigeria. So they often have to hire outside the continent even. And there was a lot of backlash for the way he phrased some of the statements he made. But this was basically what he was saying, that there isn't enough talent. They had like 500 job openings or something like that, and they haven't been able to fill them. The senior level talent is hard to retain because they're always looking for like bigger opportunities, right? And there isn't enough of a pipeline when it comes to like training talents because there is always such a high churn rate. And so in this case, the CEO of TymeBank is betting on the psychology of ownership. If the employees own enough of the company, then maybe they are incentivized to stay, incentivized to make sure the company is successful. And of course, this is the type of move that if things go well for the company in a couple of years, they're talking about generational wealth. So it's very interesting, not something you see often. And I don't know, what are your thoughts on this? Have you, did something you've seen in the banking space? I know you have more expertise there. What do you think, Karen?
Not in Africa. The meanest employers in any economy is a bank. The meanest employer.
Wow.
Very mean to their employees. They give you bare minimum. Anyway, first of all, this is definitely an exciting story for me because we have discussed this severally, and I'm hoping to see how it's done so that its people are actually being protected. We have seen several employees taking their employers to court because while they were supposed to have the shares, when it comes time for buyout or an exit or a sale of stock, then they are shortchanged. So that's something I hope will become clearer as time goes. However, this is a bank that was number one, the first profitable standalone digital bank. It has quite a good value, 1.5 billion. They did a fundraise in 2024 of 150 million that was injected from New Bank. In addition to that, these guys are adding around 450,000 customers per month. They're doing really well. I think they generally are seeing that they have good performing staff or employees. And as you've said, it's becoming more and more rare for you to find good employees and for you to retain them because the world is a lot more open. Opportunities are a lot more out there. And I also do think that in today's world, people don't value loyalty as much as they did previously, where you started with a company and you wanted to stay with them until you retire. Today, we're seeing people being more and more comfortable with movement. And it's getting worse with each generation, it seems, as we also look forward to possibly a world where most people will be contracted professionals as opposed to full-time employees. I do think that's one of the things that we will continue to see growing. However, this is a really good cultural move of showing that, yes, we value you, and also giving you a stake in the company means you care more, you're working towards your future, and so you stay. We've also seen that they're trying to become publicly traded. And so perhaps this is saying that we are looking to generate real wealth for the people who built this company, because when we go to market, they're signaling that to us, that when we do become a publicly traded company, then we will see our people start to make really good cash. Good to see. I think that's a really good move when it comes to building the culture of a company. And I'm just shocked. 2,000 people. I do think they're doing really well as a company, and I wonder how much better they will do, because I do think it's a strategic once this is done. I think it's a very good signal to the market that we're doing well, and when we go public, we will do even better, and we'll be able to get quite good money for the people who have built this company.
When you put it like that, it sounds quite nice, you know. It sounds like they popping champagnes over there.
We hope that's the
uh,
case inside. It's not
oh,
just PR.
yeah, exactly, exactly. There's nothing hidden under the sun. So, in time, we'll see what was really happening.
Yep. So from 2,000 people getting shares in a company to 200 people losing their jobs, Africa's biggest e-commerce platform is going through aggressive restructuring. Jumia, which is Kelvin's favorite company in Africa, if you do not know, is planning to cut at least 200 full-time employees over the next 2 quarters, which is roughly 10% of its current 1,980 person workforce. They have stated that AI is now handling tasks in logistics, customer service, finance, cybersecurity, seller management that previously needed full-time human teams but do not need that anymore. So Jumia used to have 4,318 employees at the end of 2022. Now they're at 1,980 and they're cutting off 200 more people. It's quite a steep reduction in human resource. And I think it's something that we have been seeing across the board in tech companies. And I think it's something that we will continue to see. So, Kelvin, what do you have to say about your favorite company?
Here we go again. I mean, like you said, it's something that we are currently seeing with tech companies, a lot of reduction. And for Jumia itself, we know that there has been that aggressive push for a couple of years now to profitability. We kind of knew it was only a matter of time. Before now, they have been like cutting down, like you said, from 4,000 plus to now just under 2,000. And we know that there are probably still a couple of cuts that they would have to undergo. But for this particular one, they are saying it is driven by automation and AI, which is quite different from the previous cuts. That means they are beginning to trust the technology. They have probably been using it internally to see whether it's something that scales, and they are now making that step forward to actually implement this in practice. That means 200 less jobs, possibly more in a couple of months. They are projecting that they will be profitable by the fourth quarter at the current rates of the cuts, and looking at their revenue, looking at their profits, looking at their losses, and seeing how AI and automation can also impact that. It's a hard one because every company is doing it at the moment, or at least a lot of tech companies are doing it at the moment. So I'm still generally on the fence about where we finally settle when it comes to like hiring and operations. Generally, personally, I have always believed in leaner teams that do one thing and one thing very well. But Jumia, like many companies that started around the time that Jumia started, did a lot of scaling and expansion at the beginning with all of the investments that were poured into the company. And once that died down, they started to scale down, leave countries, job cuts, and trying to now optimize for profitability. So it's definitely one that is a hard one, but I don't even think it will be the end of the cut. So
Yeah, I agree. And they do say AI is one of the reasons why they are compressing their staff numbers. And I think we'll continue to see that because AI is genuinely starting to cause a compression of headcount in businesses. And I think that if you are a HR person in a startup or in a tech focused business, especially, and you have a lot of back end roles where you've hired people or you need to hire people, I think it will be important to do audits for what can be done by AI before we hire people moving forward. You don't want to hire and then fire after a while. You want to do the audit before you start the hiring. That might have to become part of HR's processes, just so we're not hiring and then firing after a while. It may have to be how much of AI are we incorporating, or can we incorporate into the company, and then how much of human intervention do we actually need? Which brings in the conversation we had earlier before we started recording on the cost of AI in the future and the expectations and the consistent evolving of what AI can do, what its fundamentals and basics are. There's a lot of bouncing still happening, figuring out the right mix of human to tech, human to AI agents. So there's a lot of balancing that HR has to do moving forward, given that costs are running high, economies are constricted at the moment, and AI is shrinking headcount. So a lot of things to think about.
Definitely a lot of things to think about, and I don't think anyone has all the answers at the moment. It's something that, just like the Industrial Revolution, we would have to adapt as humans always do. And just like the Industrial Revolution, that was painful at the beginning but brought with it a lot of growth, I believe we are currently at that moment in history of the pain of the AI revolution, and maybe in a couple of years' time we would start to see some of the gains. But yeah, no one has all the answers. And speaking of the fragility of the tech space, our last story touches on a startup that shut down Money. They provided essential cross-border payment infrastructure designed for business clients. So in this case, they were even seemed like they were B2B primarily. And even though earlier in the year we talked about how a lot of startups are moving from B2C to B2B to consolidate their revenue and stability, we are seeing one in this case that's actually puts itself out as a B2B, but is shutting down at the moment. The main issue the founders cited was that product was great, but they couldn't raise enough funds to scale. And this comes down to licensing and fees and regulatory requirements and compliance costs and things like that. So the product itself was good, but raising funds to scale it to the next level proved too difficult to do. The founder reported that he tried to see whether he could sell the company to somebody else, but the offers he got didn't make sense. So he made the decision to shut down. A lot of thoughts. I would like to hear yours.
Yes, I also have a lot of thoughts. First, I think he only raised $1 million. That's very little. To be
About it's not even clear what the actual number is.
about thereabouts.
Because I read his like statement on Twitter, because he put out the news himself,
Mhm.
and a lot of these things, blogs and publications carried the news. So what he said was that they raised under $1 million. Now, under $1 million is a very broad range. $1 is under $1 million, so it's not clear. I took a look at Crunchbase, and Crunchbase shows around $250,000. So it's not really clear how much they raised.
So, yeah, so I think that was too little for them to be able to do compliance, build the API infrastructure, distribute at scale, the marketing itself, cost of acquisition per customer when it comes to fintech is quite high. So, I think that was the first blow. Now, my mind goes to this. I do think, and you can correct me because you might be more conversant with the founder. I do think that the founder was probably a technical person who's very good at building out products, but doesn't understand the politics and the nuances of business development. That's an opinion from my perspective, where he's able to build a very good product, but he doesn't have the understanding of how to raise funds, how to market the product. Because even when you look at the numbers that were being used to come up with a conclusion as to what really happened, those numbers were really low. The reviews that were online were very few. So I do think that the distribution part was a major problem. Here's what I think. If you are a really good technical person who's able to build very good products, you need a partner who's very good at sales and marketing and business development, because then they're able to think in terms of what do we need to get people to fund us, to get people to understand the product. Because another thing with technical people, most of the time when you sit with them, is they talk in very complicated jargon that perhaps as an investor, you're not really sure what that translates into. This is just me giving an opinion, though. I'm not saying that this is what Uchi was or is, but sometimes you need someone who's able to translate the technical perfection of the product into sales and investments. I think that's one of the things that perhaps became a problem. The other thing is distribution has to be thought of from the beginning of the product being created, because if nobody knows that your product exists, then nobody is able to use it. So it has to be a strategic thought from the beginning of producing that product. Your sales funnel has to be at the beginning. It can't come once the product has been built out. It has to come in before the product has been built out. I was actually listening to someone and he was saying that most startups now are focusing on building with the customer, right? So you don't build the product, you build it with customers. You give very good incentives for them to come in and then be part of the whole build, so that you understand their pain points and you're able to build based on what they need, what bringing in that feedback. But they're paying you as you build it out and you're validating the product itself, so that you have a bit of a distribution already carried out as you're building the product. The customers are already within the pipeline. So sales funnels have to be at the top of mind when you're building out the products that you're building out. I do, however, think that Uchi has set an example for what it is to have some form of integrity when something doesn't work. I think he has tried to be quite transparent about it. He is refunding users, he is documenting his APIs, he's preserving the licenses. Perhaps something new is coming up, I don't know, but I do like the way that he has gone about with closing down. Of course, we have a lot of questions. The how much was raised being the main one. I do think the under $1 million is a PR thing, just to show that it wasn't that low, but it might have been, as you said. Yeah, I think that's where my thoughts go.
You said quite a lot.
Yes, I apologize. The woman in me has to give a lot of words.
Where do I start? I agree with you largely for a lot of the points you raised. So, when I was doing some research about the company, because, well, Startup Graveyard, it's what we do, I was trying to look at some of the details about why this happened. And just on the last point you raised, they built a lot of good APIs. And I believe this is the second API startup that I have seen while analyzing startups that have shut down in Africa. The first one was a couple of years ago, DPA. I think if you look at it, they are quite similar models. And this is the second one that is shutting down. So maybe there's something there that is not scaling correctly. Because when you look at what was reported, he tried to raise funds. So that means he met investors, he pitched the idea to them, he probably showed revenue because it was an operating business, and they were not convinced enough. And then next thing, he tried to sell the business, and the offers he was getting were also, from his own point of view, not enough. So it's also brings some questions into what did the people see that maybe they didn't value the business enough. Yeah, so there are some questions there. One of the things you also mentioned was technical people. We do fall in love with the technology a lot. But one thing you learn, or I have learned while working on Startup Graveyard Africa for over 2 years now, is that the market doesn't care about your feelings about your product. It doesn't care at all. The market cares whether you are solving the market's problems. And that is all it comes down to. As technical people, we have a lot of jargon. I'm probably not one of those people because I like to talk in simple terms. And that's why a lot of times I'm looking for the terminology for things, because I like to keep things simple. But a lot of my technical colleagues, especially those of us that write code, I should say, we do fall in love with our code. We fall in love with the products we are building. And sometimes it's hard to see beyond that. And that's why, if you're a technical founder, you definitely need someone that is more business inclined, someone that also doesn't care about your code and can tell you straight, this is what the market wants. And of course, the way products are built these days, you get feedback from customers very early on and refine the product over time. There are a number of questions, but I think some of the ones to highlight, this is another API startup that shut down. And also, very similar to shut down and return funds back to businesses. The peer did the same thing, returned funds back to investors. There are a lot of similarities there to point out. I'm sure when we do a full case study on that, we'll probably put all these details there. But yeah, it's another one that has gone down. I believe there's a solution there to be built. I just think we haven't found it yet. Or to the next person. Maybe someone listening to the podcast can do something different there. But I think now you have two case studies that you can reference to see what they did wrong and maybe try to get it right, because there is definitely a solution there.